Thank you for being with us. So effectively, as a matter of fact, we're going to discuss private equity going evergreen. But to make everything clear from the beginning, what are the main differences between traditional private equity funds and evergreen private equity funds?
Yeah, and thank you for having me. Great question, because evergreen's becoming a bit of a buzzword these days, especially in the private markets world. If you think about traditional private equity, private market funds, which we've had for many decades, they've been closed-end vehicles, 10, 12-year lockup vehicles. Investors commit capital on day one. Capital is drawn over time, distributed over time. Investors don't necessarily know when capital will be called or distributed. You have different ways of measuring performance because the manager doesn't actually have your capital at all times. And therefore, you can't actually plan very accurately what your asset allocation will be because you don't know how much exposure you'll have in 4, 5, 6 years. And evergreen funds are trying to take away those obstacles. So these are vehicles where typically you'll be invested fully on day one. You won't have capital calls. You might not even have any distributions. You remain invested until you choose to redeem, and you get exposure from day one. So it's making it easier for strategic asset allocation.
Given the rise of evergreen, would you say it is simply a matter of repackaging, or does it signal a deeper, a bigger transformation within the industry?
It's probably closer to the latter. I think there's two very large trends that have affected our industry over the last 25, 30 years. The first is simply the growth of wealth itself. There is significantly more high net worth, ultra high net worth capital in the world today. It's been growing faster than most other pots of capital and investor bases. And as that has grown, it comes with its own requirements. Investors have different needs, different requirements, which need to be addressed by asset managers. So I think that's trend one. Trend two is private markets have grown. We've all seen statistics that more companies are choosing to go private or stay private. By some measures, there's 10,000 times as many large private businesses in the world as there are public businesses. When you combine these two trends, you realize that investors need or should have exposure potentially to private markets, and private markets need to therefore package it the right way. So I would say it does seem like a transformation, but it's more structural. Underlying, there isn't actually a change. Value creation, long term, illiquid, none of that is changing. It's just the way people are accessing it.
Okay. You mentioned these closed-end funds, and this is traditional private equity. They operate through capital calls. Evergreen funds, they invest directly upon entry. But how does it affect? Does it impact the way managers are building and managing their portfolios over time?
Yeah, operationally, very much so. And I think in our view, there's a spectrum all the way from managers who are simply applying an access route but not changing anything underlying, all the way to new strategies that might come up to sort of address evergreen demand. And the more you move to this side of the spectrum, I think the more you'll need to think about operational changes in a firm. And I think, therefore, it's very important, even more so, I think, today, for investors to do operational due diligence to make sure the firms are capable of this completely different way of doing things. On this end of the spectrum, I think the larger firms, which are what they are trying to do is just build access routes, don't change what's happening under the hood. It is simpler. It still requires you to do the due diligence and make sure people have thought through the operational implications, but it's significantly easier than creating new strategies.
What makes the evergreen model so appealing today, both for investors but also for asset managers?
Yeah, for investors, I think the simple answer is flexibility, right? I mean, investors will decide whether they want exposure to private markets or not, but it's now easier to access it. You can choose if you want 3% in private markets. You can get 3% in 30 days rather than trying to predict capital calls over 3 or 4 or 5 years. And then if you change your mind in 2 years or want to increase that to 4%, you can actually do that. So the flexibility is probably the key word here for evergreens and investors. For asset managers, it's an interesting question because it's actually quite difficult. It's not. It's significantly more difficult to manage for firms that have not done this before. I think the key reason for firms like us to do it, one, you're accessing investor capital that you otherwise can't access, and two, related to that, you're diversifying your client base.
Thank you. Thank you, Vai, for being with us today and for sharing your views. Thank you.
Thank you very much.